Hi, I'm Phil Lackman, CEO of the Independent Insurance Agents of Illinois, and I'm joined today with Evan Manning, our Director of Government Relations, and Brett Gerger, our Director of Education and Agency Resources. We're here today to talk briefly about House Bill 2203, legislation that would regulate rates and underwriting for auto insurance in Illinois. Evan, tell us about a little bit of background. What's going on? Why was the bill introduced? Who introduced it? And what's going on?
So House Bill 2203, introduced by Representative Will Guzzardi. He is the Progressive Caucus Whip for the House Democrats. So he is a very progressive individual within the Illinois General Assembly. But what this bill does, it really eliminates a number of factors. First of all, it would eliminate the file and use system that we currently use today. It would slow down the process dramatically for auto insurance carriers trying to file their rates in the state of Illinois and seeking prior approval from the department for their rates. So what House Bill 2203 would do is it would increase premiums across the state of Illinois for Illinois consumers. Illinois, as you know, is one of the most competitive, if not the most competitive, auto insurance industry space in the country. Illinois is ranked fifth in the country in size, but we rank statistically right in the middle of the pack for auto insurance premiums, affordability for auto insurance premiums in the state. House Bill 2203 is introduced currently. It's still in the House Insurance Committee. We are working with our industry partners in defeating this legislation, but obviously it is still very much alive. We are working every day to make sure this bill does not get passed this year.
Brett, you served on nearly 25 years at the Illinois Department, started off in producer regulatory and rose to Chief Deputy Director over property. Illinois has had a long history of open and competitive rating. Tell us about the department's background, how it's worked for Illinois consumers.
So it's been great for Illinois consumers, Phil, and we've fought this battle at the department for 20 plus years. These groups, this isn't new, but the legislation has gotten further than I've ever seen it get, so it is serious. But what it does is it takes away competition. And when you take away competitions, you're going to have insurers exit the market, and you're going to have new insurers not enter the market. It's going to take away innovation. And the best thing for independent agents is choice. You give your consumers choice every day. It's going to limit those choices now. And when you limit choices, rates are going to go up. And it's a bad bill for Illinois. It also, the underwriting features are not going to be great. It's going to take away a lot of factors that do go into figuring out rates, and it's going to spread that risk over the entire state, which will raise rates. They're not going to have as many underwriting choices to pick from. So at the end of the day, this bill, it's going to be a bad deal for Illinois if it passes. And it's probably the most progressive I've ever seen it. In the past, they just wanted rate regulation. They never spoke of underwriting. We had the credit crisis that we fought, as a regulator and as an industry. And we came to some common ground. I don't know that there's common ground here. This is just a bad bill on the surface, in the minutia. Any way you look at it, this isn't going to be good for Illinois consumers, and it's not going to be good for independent agents.
Brett, the department, like many agencies in state government, is understaffed today. And so how would they be able to deal with hundreds of companies filing these rates in an approval process?
So you need, they always talk about actuaries. Well, this is a special type of actuary. It's a rating actuary. They make more money. They're more specialized. You can't find rating actuaries in Illinois. We have a couple of insurers here in town, the Horsemans and that. They're going to hire those people, and they're going to pay a wage that the state can't pay, and there's going to be fewer choices. Even in Chicago, you just can't pay a rating actuary what they can get on the open market. And so it's going to be super difficult for the department to staff this. When I was a regulator 20 years ago, we had 420 employees at the department. I think they're just a little below 200 right now. And a lot of those are interns. So it's really
So the expectation for the department to get these rates and have a quick approval process is unlikely.
Very unlikely. And you're not going to, they don't have current staff that can do it. So they're really going to have to, it's going to be a hiring process. and to step in and think this is going to happen, it's not going to be a quick process, as with anything.
Evan, you've worked every member of the committee. You've spoken to the chair. We've launched Grassroots for our members who are in members of the insurance committee's districts. What are the prospects? What's going on right now? The industry is united. We're working very closely with our companies.
So, as everyone knows here, no bill is ever dead in the state of Illinois. Deadlines really don't mean anything, as many of you might know. But this bill is currently in the House Insurance Committee. It's actually in the main subcommittee for the House Insurance Committee. So what we're trying to do as an industry is make sure it doesn't leave subcommittee or even to go to the parent to the parent committee. We're currently working every day with General Assembly members, the House Insurance Committee members, to make sure this bill does not get out of committee and not reach the House floor for a vote, let alone get over to the Senate. So we're working every day to fight that battle.
So there you have it. House Bill 2203 is bad for Illinois consumers. It's bad for our member agencies. It's bad for the industry. We have an open and competitive rating system that works and works well. We have a great story. We're happy to tell it.